Good morning, everybody, and welcome to Privity CPA's monthly webinar. Everybody up on the screen today. Welcome. We will be sharing our business topic. We will be actually talking about real estate and entity choice tax strategy guide. Let's do that. So I wanted to welcome everybody today. I think we've got quorum present. Should we wait any further, Stephanie, on more people? Can you see the board? Do we have all of our quorum present?
Yeah, we're good to go.
Excellent. Well, I would like to welcome everybody today. Our topic today is about real estate or other assets and entity choice. We're going to talk about some of the implications to tax strategy and help you make informed decisions about how to structure your entity and your assets for both liability and taxes. I want to get into a quick, important disclosure. We do need to talk about a few different things. This is for educational purposes only, which does not constitute official tax, legal, or financial advice, especially legal, since we're going to be kind of tripping into your attorney's world today. Attending or viewing this webinar does not create a CPA client relationship, although we'd love to have one with you if you'd like to have us. But doesn't create a relationship between you and us at this point by just watching it. Tax laws, as always, are highly complex and they constantly change. So we encourage you to make sure that you're actually seeking out the advice of CPA, including us specifically if we are your CPA, or attorneys for advice tailored to your specific situation. We're happy to give you that counsel, but we can only do that as you are a client of Privity CPA Partners. Individual circumstances may impact this. We're going to talk a little bit about California today, and we're going to talk about federal implications. But for the most part, every place has different tax rules, so we're not going to get into all 50 states, international, et cetera. And if we do talk about past performance or things that we've done in the past, that's not a guarantee of anything in the future. So with those things out of the way, let's get to our presenters. My name is John Hannum. I'm a CPA. My background is as CFO and corporate strategist. I like to say I'm a recovering CFO, practicing CPA. So I like to help business solve problems. With Privity CPA, I try and help business owners, real estate investors, and anybody with assets or operations to take care of look really past their basic accounting, get some big picture strategy, and really make their business grow, not just keep the money from the government, but as it grows, keep as much of what they can as they scale and build. Stephanie?
Well, hello, everybody. My name is Stephanie Anderson. I'm an enrolled agent, certified tax strategist, and have a master's of science in taxation. I'm very passionate about tax, and my niche, my specialty is helping people keep more of what they earn through high-level professional tax planning.
Excellent. I think the computer actually got your hair right too, so that's awesome.
No.
It does not. Mine doesn't look like me, but whatever.
And these AI images don't look like us.
The computer tried. So today we're going to talk about asset protection and tax optimization, and those two things can go hand in hand, but they aren't the same thing. Protecting your assets and optimizing your tax strategy are two totally different things. And so we're going to talk about the choice of entity selection as a specific driver to do both things. Lawyers will, in general, tell you to grab an LLC every time you're doing something, maybe even put each property in an LLC to keep risk associated with one property away from another property. And they're, of course, entitled to that opinion. They're not wrong with the liability. Always want to make sure that your assets are secure in case you have an issue. But the tax implications of how you build and hold real estate are really varied, much more nuanced. We're going to talk today about the tax landscape so that you can make informed decisions, and hopefully your attorney can help you reconcile those two things and make sure that your assets are protected and you're paying less in tax. So
Wonderful,
Well,
John. Can I add a
oh,
little to that slide, please?
yes, please.
Thank you so much. So an LLC is a legal structure, which can be different from its tax structure. An LLC is a flexible legal entity that can elect to be taxed in a different way. So you have to understand the difference between the legal and the tax structure. And as accountants, as tax strategists, we cannot advise you on the legal structure. But the other thing I want to say is that one of the common misconceptions, something that I have to debunk almost every day in my role, is that an LLC will save you money in and of itself. That is not true. In fact, if you form an LLC in a state, you're automatically going to pay an LLC fee to that state. And in California, the minimum fee is 800. But depending on what your gross sales are, you get taxed on the gross, not the net for the LLC fee. So tax planning is of utmost importance when deciding to form an LLC.
Excellent. We skipped ahead a little bit in the presentation then. So what we plan to cover today is what Stephanie has kind of started there about all the different aspects of both corporate formation and the taxes associated with that. So and we'll go
We
through.
can dive further into it.
Oh yeah, we're going to get super deep, and I'm super excited about it. The What we'll cover today then in the overview, we'll look at the liability versus tax distinction and kind of talk about the two different ideas of liability, which we cannot advise you on officially, and tax distinction, which Stephanie is highly qualified to advise you on. We're going to talk about the different taxes that apply specifically to real estate, but income in general. And those are income tax, self-employment tax, capital gains transfer, and how each entity choice affects those taxes. We're going to look at some of the entity types that we're talking about, the legal structures that Stephanie was mentioning, owning things individually through LLCs, S Corps, C Corps, or partnerships. And then we'll figure out some of the decision framework. Skip to the end, I'm going to tell you that you should really have a tax planner involved, to help you make those decisions individually because they're very complex. But we'll talk about some of the drivers that impact your choice. So super excited to do that. Let's jump into the detail then. Lawyers are going to talk about liability, and that's what we're going to avoid from this point forward. CPAs, enrolled agents, we talk taxes, and you do need both. So, like I said, attorneys will tell you every time, grab an LLC, stick it in an LLC. As Stephanie mentioned, that's going to cost you $800 off the top in California. So there's some tension between those two things already. But in general, an LLC creates a legal shield between your asset and your liability so that if something happens with that one property, they can't go outside that LLC to grab assets from your other protection or from your other entities and yourself. You're protecting your own assets as well.
Now, there's a caveat to this. Mm-hmm. Just because you have an LLC doesn't mean that it's going to hold up in business court. Most attorneys are pretty good at proving that this person did not act as a separate entity from them as a person. So there are many business formalities that you would have to adopt. A lot of nitty-gritty detail, how you sign your checks, how you put what return address do you have, those kinds of things. So even if you have an LLC, you must learn the business formalities in order for it to protect you.
And they call that piercing a corporate veil. So if you have an LLC, it has to function like an LLC. You cannot treat it like your own asset. It has to function like a business. And that's where lawyers can advise you to properly set things up, make sure that you're having meetings, documenting your minutes every year, behaving like more of a corporation than an individual. So from the legal lens, you want to protect your assets and make sure that they're really in a properly formed LLC or other entity, and liability is taken care of. From the tax lens, our focus is minimizing the income tax, but that also has a lot of other taxes to it. So the self-employment tax, capital gains, estate tax, if you're talking long enough, And that best entity is going to vary by situation. We're going to talk about each individual entity in particular. So legal lens, we're going to stop talking about in general. Tax lens, we're going to focus on. But the integrated answer is you need both us and a tax attorney or some type of attorney to make sure that your entity is bulletproof.
Yes. So single member LLC is disregarded for tax purposes. And that is where it could get a little hazy on, are you acting like yourself? Are you acting like an entity?
So let's talk about the types of tax that we're actually going to be addressing and what income taxes drive the taxability overall. So there's four main types that we're going to talk about today. Other states and different taxing authorities might have different taxes, but the four we're going to address, because they're universally ubiquitous, yeah, are income tax. That's regular, ordinary income tax. That is, when you rent something or when you get income from a property, you're going to pay income tax on that. And entity choice does affect whether income is reported and where it's reported and how much you're going to pay on that. There's a self-employment tax. So you as a person may pay self-employment tax of 15.3% or more, depending on your state, if you have tax on your net earnings and you're self-employed. And whether the rental income triggers self-employment tax really depends on your activity level and a bunch of other different things, including entity type. But it's a major planning lever, right? Paying the self-employment is going to cost you 15.3%, and if you can get out of it, it's going to save you 15.3%. But that's very nuanced. So Stephanie will dive in very detailed into what drives that lever, but it is a major planning lever. The capital gains tax is when you sell anything. Whenever you buy something, you accumulate basis by what you buy that property for and what you put into it to improve it or to build on it from a capital perspective, not your operating cost, but your capital. And so whatever your basis in that is, whatever you sell it for is a gain, and you're going to pay capital gains tax on that. Your entity structure and your holding period both matter for that. So you'll be taxed differently under a different entity type, and however long you hold that. You'll be taxed either 0, 15, or 20% on whatever that difference between what you bought it for and what you sell it for. And then lastly, we'll address transfer and estate taxes, and that is not an income tax. The unified transfer tax is when you die, or get rid of those assets through a generational transfer. You're going to gift, sell, or pass that property at death. And there's some really important tax consequences to that and some tax benefits. I'm not going to say there's a good tax benefit in dying, but there is.
Wow.
So it might be probably not the best tax planning, but it should impact your idea of what you want to do with your property, especially as you have property that is super valuable. So we want to talk about those as part of the idea of all the taxes you pay. There are a lot of other taxes. These are the main four that we'll talk about today. Stephanie, anything that you want to mention before we dig into how those impact entity?
No, ready for the next slide. Thank you.
Excellent. Okay, the self-employment tax is probably the biggest hidden variable here. And self-employment tax is, as we said, 15.3% of your income. The key question that we're going to ask ourselves in a rental activity, if you're going to have a property for rent, is it a trade or a business, or is it a passive rental? Do you're a real estate professional? Or are you just renting a property? Passive rental normally avoids self-employment tax, which is great. But if you actively manage it, like short-term rentals, et cetera, you might actually be tricked into paying or trip into paying this 15.3% tax unless you have some distance between you and the property. So, hiring somebody else to run it, a third-party property manager, can give you that passive characterization. But if you're doing for example, on an Airbnb type property, if you're actually actively doing it yourself, you could actually trip that and have to pay 15.3% of your income to the government for this tax. So in this case, an LLC doesn't actually even shield you from that tax, right? You're going to pay that. It's the nature of the activity, whether you're active or passive, not the entity type that is the determining factor. And we can talk a little bit about, in the right-hand side there, the tax exposure by activity. So long-term passive rentals is usually no self-employment tax. If you hire a manager to run your rental, usually no self-employment tax. But if you actively manage it or self-manage it, the potential is high that you'll have to pay that tax, even if you have an LLC. Run short-term rentals, the activity level goes up, so it's you're probably going to end up paying that. And if you're running like a hotel or some type of thing where you're really providing service, you're probably definitely going to pay that self-employment tax. And this is a 15% tax. It's not small. Anything else?
Great. Yeah, so this is what I'd like to say. All real estate is deemed passive unless it hits a couple of boxes. The first one we look at is the average stay of the tenant. So most of the tax returns that I have worked on in my career and that come in, most real estate is passive. It was with the Airbnb becoming super popular, right? That we started having to really dig into the average stay of the tenant and our substantial services provided, and really looking deeply into how time is spent and does it meet the mark. So there's many characteristics to look at. And this is a really perfect example of understanding how each different taxpayer has different facts and circumstances. And so you can't make just broad, roomy general statements. You have to look at each individual situation. And that's why there's no quick questions in tax. So if right now you're looking at this and you're wondering, do I have a long-term rental or a short-term rental? Is it active? Is it passive? Then, that's because there's no way to make blanket statements. Everything is individual to your specific facts and circumstances. And ironically, there are many benefits to making the real estate active, which we won't go into on this slide.
I think go into it a little bit on the next. So this slide is kind of a comparison, and this is where we can spend a lot of time talking about the matrix of entity type and the type of tax and where it exists. So when we talk about the entity types, we're going to talk about a few different things. Stephanie's already touched about on the LLC or corporation is a form of corporation. It's a legal form of corporation. And then each LLC could be elected. It's automatically a C corporation unless you elect to be an S corporation. So we talk about the couple entity types being LLC versus corporation. Then you have the election of whether you choose to have that S election or C election. We'll dig into those more on other webinars. So the way that we've structured the entities here is a person holding an individual, just holding an asset individually as themselves, as their person that doesn't provide the legal side of the protection.
Sole proprietorship.
Sole proprietorship, right? It's just part of your own assets. Then if we form an LLC, that we could have a single member LLC or a multi-member LLC, right? If we have one person, it's an automatic disregarded entity. If we have multiple people, then it's, may be a couple different things, but probably a partnership. And if that is an S corporation, that's going to pass through to the individuals. And if it's a C corporation, it's going to have its own tax. And so how that is impacted across the top in the different types of tax, we have to think about the impacts to income tax, self-employment tax, capital gains, and then some of the flexibility of whether we have flexibility to change, et cetera. So I know it gets pretty detailed, and Stephanie, hop in anytime.
Okay, I would love to.
Yes.
Tax entity selection is the very first step in tax planning. right? You look at your entire holistic situation, all your streams of income, all your liability, and you first have to figure out what is the best entity to hold this income. And real estate takes the most analysis, right? Because if we are trying to get to real estate professional, which means that if you have multiple long-term rentals and you're spending 750 hours a year or more, and it's your main activity, meaning you don't have a job, you don't have a job which accounts for 2,080 hours of your time, then we need to really look at this because we're going to group multiple long-term rentals together, and we wouldn't want those in separate LLCs to do that. So there's so much to look at, and the purpose of this is to make you aware of what you may not be aware of when you are faced with making hardcore tax decisions, which could have a huge impact in the amount of tax that you pay and your liability exposure. So there are my attorney, I just want to share a little story, but for my real estate investing, my attorney was very much against me forming LLCs and just said, oh, just get umbrella insurance, you know. So I thought that was funny. It really just depends on, you know, who are you leaning on for your advice and what is their exposure to the real estate industry. But from a tax perspective, there are actually 400 tax strategies that are completely legal, that have high tax confidence levels coming out of primary source citation. 400, right? That we study in the Tax Planning Institute. Now, most of those have to do with real estate. So these are not easy, simple, quick questions. A deep analysis has to go into play with how you, if you're single, just you, if you're married, how both of you spend your time, what type of tenants do you have, where are these located, what is the prior depreciation? And that's really what we want people to walk away with here, is the awareness of what an important decision this is.
Very true. And it is, as the chart indicates, there's so many different types of tax. It's pretty complex in the idea that, individual or your entity choice can really impact so many different things.
Right,
Can I
John. And a high controversy. If you get a room of tax professionals together and you talk about putting a piece of real estate in S corporation, there's going to be a seething cauldron of debate. In general, you don't want to put real estate in S corporation. There are some exceptions, but they are few and far between. So that would be a nice bonus tip.
It is. I think we go into single and multi and some of that in the next one. Let's just talk about the mechanics for 1 second so people can understand what the mechanics are. And so that is entity type does impact the income tax and the other taxes very specifically. And so we can talk very quickly about what those entity types do. So individual is just individual. It goes into your tax return, onto your income. If you have W-2 income, it sits right on top of that, and creates some passive income. You can't necessarily, if you have losses, offset those losses because it's a different type of income, but it sits with you and right on your tax return. So it is taxed at your personal rates. There's not really a lot of self-employment tax risk. It's low if you're passive, but whenever you sell that, you're going to do a personal capital gain rate, 0 to 20%, probably 20% if you're hold it long term, et cetera. So you probably end up paying about 20% on your capital gains whenever you sell it, unless those laws change, and capital gains laws could change with the tax code. Single member LLC is officially a disregarded entity. It provides a legal idea of an LLC, but for the tax purposes, it says you're a single member anyway, so everything flows automatically to your income tax. It's disregarded, so it's really the same as individual, but it is a company that you have that's separate. Also low income, low self-employment tax risk, just because you're still passive, and it feels like individual even if you have an LLC. If you have multi-member LLC, you're with other partners. You may choose that to be an S corp or a C corp. Doesn't necessarily matter from that perspective. But if if you're just a multi-member LLC, you're probably going to be run a partnership return, and there's a lot of flexibility in that we'll talk about in a minute. You can pass that through, and your tax at your individual income rates. The self-employment tax risk does vary by whether you're participating or not. It varies by the member's role, but the partnership has a lot of flexibility to divvy up income differently, et cetera, but it is passed all through to the partners. S Corp and C Corp being the two tax elections that you can make with your LLC or corporation. S corporation gets passed through at personal rates, just like a partnership or just like a single member LLC. Your portion gets put through. There's less flexibility in handling that versus partnership, which gives you more flexibility in allocating the partnership earnings, et cetera. And in S Corp, you have to go by the amount of ownership and pass through, et cetera. And then C Corporation might seem like the worst option because there's always a little bit of double taxation. The entity is going to pay a 21% tax on its income, and then you're going to have tax on your distribution and called dividend to yourself. So there is a risk of double taxation on all of those. So that's a little of the mechanics. We can now talk about specifically the LLC, and this is where Stephanie was going with the single member LLC being a disregarded entity, the multi-member LLC being a partnership, and then the LLC electing the S corp status. Has a lot of power there. Couple things on these. Single member LLC is just going to go on a Schedule E, so there's no separate entity return. You won't have to pay your tax accountant a lot extra to file a separate return, or pay. You will have to pay your LLC tax because it is an LLC, but it's kind of a liability protection without a lot of tax complexity. For a multi-member LLC, you have a lot of ability to change the pass-through income to the members, depending on whether your members are adding capital or expertise or running it. You can really structure your partnership arrangement to do interesting things with your profit and loss allocation, special distributions. Very powerful for co-investors, especially if you have people that are not contributing the same amount of property to your LLC. And of course, if you elect S Corp status and you properly elect that S Corp status by filing the right forms, et cetera, once the IRS acknowledges that, then you pass their income. But there's a lot of structure in that. You have to divide your income according to the cap table. And there is some ability to do things like reasonable comp and some payroll compliance that will help you reduce your exposure for self-employment tax. Did I get it right, Stephanie?
Yes, that's wonderful. I would like
Excellent.
to add to the conversation, go backwards, the S corporation status. So if you have a third party loan, right, which you more likely than not would have with a mortgage on a piece of real estate, that's not going to create basis. That's not going to create debt basis. And when the property leaves the S corporation, the tax situation is not favorable to the S corporation owner. So it is the least favorable choice for real estate investors. Oftentimes people have multiple rentals. I mean, I'm talking about a large portfolio, and they'll have an S corp on the side that acts as like a management company. And so that might be something where it works, but you have to really look at that, right? Management companies, they have to be done right. Multi-member LLC, again, partnership law is one of the most complex things that exists on planet Earth. But they are very flexible. They can work when you have a debt basis and you have, uneven things happening within a partnership. And if your transactions are coming through on a K1 on your 1040, that alone reduces the audit risk. You have to look at the statistics on the audit risk. I often use this when making entity selection when I understand my client. Is my client an excellent record keeper? Is my client logging into QuickBooks or Xero all the time and doing great bookkeeping? Do I have to ask that client 12 times for their bank statements? So if that person is not really good at record keeping, I don't want them filing Schedule E or Schedule C because those are they have higher audit risk compared to a K1. So you have to look at that. Now they may also balk at having to file an additional return. So these are decisions, again, it's the facts and circumstances of that individual taxpayer and getting to know your client and understand how they operate in order to make the right, to present the right choice in front of them. So now we have a single member LLC, which is a disregarded entity. And yes, the default is Schedule E. But if you are doing a short-term rental, if you're providing substantial services, we're probably going to put that on Schedule C, mainly because the Schedule C will automatically flow to calculate self-employment tax. So there's not automatically self-employment tax calculated with Schedule E, and with Schedule C there is. But since 2018, with the tax TG, Tax Cut and Jobs Act, Form 2106 went away, which was unreimbursed employee expenses. And there was a lot of abuse and a lot of fraud on that form. And I'm so glad it doesn't exist anymore. But that was the most audited form. And now Schedule C is the most audited form. So I have to look at my Schedule C clients and say, you have to understand here, and it's okay to undergo an audit if you can substantiate the position you took on that return. And that comes down to good accounting and good record keeping. Mileage logs. And let's face it, people are overwhelmed. Some people are better at it than others. So you have to understand where you fit into all of that. All of these things go into deciding the right entity structure. There have been multiple times that we have, and this is a collaborative decision with the client, but gone with a different entity type just because of their record keeping skills or lack thereof. Thank you for letting me say all that.
Yeah, of course.
That felt good.
And there's, in addition to the ones that Stephanie mentioned, there's a few other type of drivers for your decision making. Right, we've already talked about some of these in the formation of corporations and multi-member versus single member, et cetera. But there really is no single best entity. So you have to think about both your structure, your record keeping, all of the things about you and your facts and circumstances. And I think that some of these really are the main drivers behind whether you should create an entity not, or which entity type to use. So talk about each one individually. Activity level, this is passive investor versus active operator. Stephanie mentioned earlier that people that have a lot of real estate, et cetera, can be real estate professionals and can shift that income from passive status to active status. It could be a major planning lever for your tax. And you probably have much more to say on that one, or any one of these. The number of owners.
I could talk for at least 2 hours on each topic.
Well, you have 25 minutes. One that gets kind of overlooked sometimes, but it's probably one of the most important, is the exit strategy. So thinking about what you want to do with the property. People want to get their property into their portfolio because they want to own it. They want to get the rental income. But how you want to exit from that, and if you can plan a nice planned exit would make a big difference, right? Do you intend to sell long term? Hold it? Is there a possibility of doing a 1031 exchange, which is an exchange of like-kind property with another 1031 exchanger? So, the transaction creates complexity. Do you want to pass it to your heirs, right? If you pass that, I may get this wrong, Stephanie, you have to make sure I say it right. If you pass that, your death, there's a benefit to the step up in basis of what you own all of that gain gets kind of magically erased by death, and it transfers at the basis of at the time of your death, or at the value at the time of your death.
Right? So don't do
Versus
that
if you
quick
have
claim
that,
deed.
right? If you hold that in a different way, you may not get that step up in basis. So really thinking about how you want to get rid of it in the end will help you decide on the beginning.
Thank you, John. I'd just like to say that we specialize in capital gain mitigation, and we have 14 solid strategies to help you plan your exit for any capital gain event.
But thinking about that, about what you intend to do with it at the end, certainly helps you make better decisions at the beginning.
Yeah, let's make tax smart decisions.
Excellent. If you intend to gift your property earlier than your death as well, that estate planning could be part of that as well. So, a lot of levers and key factors in the decision making. So that's really all of the decision makers and the decision drivers and the types of entities and the way that we're taxed. I think we wanted to kind of put together some ideas of typical recommendations, although these are certainly not, this is not 5 categories that you take away and say, I am one of these categories. It is, as Stephanie mentioned, 400 tax strategies on real estate, 14 specific on capital gain mitigation, very, very complex. But if we think about the impact of these drivers and your economic situation and your corporate formation, here's some ideas of how those might work out into a typical scenario. If we start with the idea of a passive long-term landlord, right? This might be a single member LLC or an individual ownership. Again, we're not talking about any longer asset protection. We're talking about just tax. There's minimal self-employment tax risk, maximum simplicity. It gives you the basis transfer at death. You can add an LLC if you want primary liability protection, but not necessarily tax savings. So, your tax strategy might be that single member LLC or disregarded entity. The hands-off investor, somebody that just wants to own the asset and pay a property manager. There's no self-employment tax exposure if we keep that single member LLC or disregarded entity, because we've created the link that keeps us passive, even if you're a real estate agent at that point. The co-investment group, a bunch of people that want to get together and buy a property, is usually a multi-member LLC, but taxed as a partnership, so you can split the profits differently. It gives you flexibility for that, special distributions, flexible allocation of the depreciation and losses among the partners, et cetera. A developer or dealer, somebody that's going to buy and improve and sell their asset, might want to be in a C Corp or carefully structured LLC. All that's going to be ordinary income, so there's not a whole lot of capital gains involved in that. You're actively selling. Your property is really considered inventory rather than an investment. You're going to sell it off and you're going to make an ordinary income gain. So entity choice and timing really become critical in that. If you're a corporation, all your tax is ordinary income, not capital gains. You might have to recover some depreciation if you sell it, et cetera, and you've taken depreciation on it. So, something to look at, though, if you're a developer or a dealer, it might be best in some situations that you're a C Corp or a structured LLC that does not take an S election. And then the active short-term rental operator, this is an LLC that probably should elect S Corp status, triggering some self-employment tax, but maybe on a reasonable comp salary, which we can talk about in another episode. You should be doing reasonable comp. If you have an S corporation, you should be doing reasonable comp. And the tax strategy there would be to elect the S Corp, limit your exposure on self-employment tax to the reasonable comp, and then you still have your ability to depreciate and operate that. But as an active short-term rental operator, it's not passive income, it's ordinary income. There are 100 more strategies, 100 more buckets. Those are kind of some that we put together as ideas. Stephanie?
Yeah, so I just want to comment on short-term rental. So we're not automatically saying that the Nest Corporation is better. Again, everything is facts and circumstances. So I want to be clear about that. The other thing is you can read all over the internet social media tax planning, which is not defendable under audit, by the way.
You mean I can't say
Can't say,
my TikToker said?
yeah, that TikToker's not going to show up at the IRS office and defend you. So the positives about short-term rental is that if the average stay is 7 days or less, now you have active, right? And if you have active, which means that you can take a loss against ordinary income. So if you have high W-2 wages on line one, there are a few things that you can do to reduce your taxable income. This is one of them. So what happens is if all the facts and circumstances are correct with the amount of time and the tenant stay, we can add on top of that a cost segregation study, but a defendable one, not garbage, something that we can defend. And then that can create a large negative number on your front page of your tax return. And so it's a wonderful tax strategy if it all works out. But there are many things to consider. How long are you going to own that property, right? Because if you plan on selling that within the next 5 years, you do not want to accelerate depreciation. There are multiple things to consider. And what we want you to take away from this is being aware of what you didn't know and what kind of factors come in to making tax smart decisions. Because if you are only talking to your tax advisor during the height of tax season over transactions that are in cement, like the prior years in cement, we cannot change prior year transactions. That financial reporting is all over the place. It's too late. So you have to be aware of what kinds of things you need to know proactively going forward so that ultimately you're in two positions. One, your tax situation is defendable under audit, right? And we know that the IRS has 100 AI projects going on and is going to start looking at all returns in the United States of America and kicking out notices. And there's going to be, little human involvement. So you've got to be more diligent than ever. And number two, that you are paying the least amount of tax that is your right. Your first bill of right as a taxpayer is to pay the least amount of tax. That's your right. But how do you know that you're in that position? How could you possibly know that you're paying the least amount of tax? You don't. You're depending on your tax preparer, or you're depending on TurboTax, or you're depending on conversations you have with your buddies at the golf course, right? So we are giving you information so that you can understand what kind of decisions go into making tax smart decisions.
Very, very great points. Let's wrap up with any questions or any ideas. And as Stephanie mentioned, the time to talk about anything to do with tax planning, tax avoidance, tax everything is before you make decisions. If you've already bought the property and shoved it into an LLC or something else, it's too late. So you want to map out all of your plans for that property, your activity level, whether you're going to have co-owners or what their tax situation is, what your idea of your holding period and exit strategy are going to be. Those can obviously change over time, but if you go in with a plan, it's certainly much better than going without a plan. And then reviewing all those options and how you fit into the matrix with your CPA or enrolled agent, with us, as it were, and then coordinating that with your attorney on any liability goals. That's the best idea before you make your next property decision. On the touchpoint side, you should probably review those entity selections and is it working for you annually? Maybe not annually, every year digging in deep, but is this working for you? Can we change something to make it more tax advantageous, especially if your idea of what you're doing with that property has changed? Certainly, if you're getting ready to exchange, you need to think about planning for those capital gains and 1031 eligibility. You would be surprised at the number of people who sell a property, take all of the money from the sale of that property, and buy a new property and then realize because they didn't do a 1031 exchange or something similar that they owe tax on that gain, and then don't have the money to pay it because they've literally tied up all of their cash in the new property. So, plan for your capital gains. If you know you're making $1 million, you need to take some, a few $100,000 and shove it aside so that it can go to the government if necessary. Tax planning can help you avoid potential tax, but it doesn't take away your tax liability if there is one. So you got to put away money.
That's true. And since we're talking about 1031, I would like our listeners to know that 60% of 1031s fail. You've got to have a backup strategy when you are in that window. So what are you going to do if you're in that window and you don't have a replacement property? We have a strategy for that. We have a very solid strategy that's actually probably better than a 1031 exchange. So just know the 1031 is like the most common thing that people are aware of and try to do all the time, but they fail 60% of the time. So call us, talk to us before you're going to dispose of an asset. Before you do anything, you want to talk to us first so that we can get the planning done from the beginning.
Very true. The best possible thing that you could take out of this is to make a plan and make that plan with people like Stephanie. Is there anything else, Stephanie, that we've missed today that you wanted to chat about in our presentation? I don't see any questions in the question box yet, but if there are any questions, we could take them. Anything else you wanted to mention?
No, I think that is plenty to ponder. And all of these things we're going to dive deeper on in future webinars: rep status, entity selection, 1031s, cost segregation, all of these real estate topics. Again, there's, of all the tax planning strategies, a majority of them are about real estate. So there's no way we can cover it in 45 minutes. It takes me years of study, years of study. So yeah, we just want people to be aware, know what you didn't know.
And to contact professional help. And this is not something, unless you have done it a million times and you really are at a professional level, that you should tackle alone. So always involve your CPA, enrolled agent, or tax attorney, etc. So we hope you guys like the webinars and what we're doing here. This is our second so far, and we're really enjoying doing them. So I'm excited to do one every month. We've decided to do them on the last Tuesday of each month because Mondays are crazy. So Tuesday seems to work out to be a better day. If you like them, please send us notes, comment, and give us some encouragement and feedback. If you don't like them, also send us notes. That would be great to understand your feedback and how they could be better. But we're super excited, and this is the type of thing we want to do to add value to our clients, to educate people, and to help them come to better tax decisions. Stephanie, anything you'd like to wrap up with?
No, thank you so much.
Awesome. Thank you, everybody, for your attention, and appreciate your attendance. Really looking forward to seeing and talking to you guys about your tax planning and your business and tax needs. Thank you so much.